Is that where the world's going? You think that it's all going to be tokenized equities?
Yeah, I think tokenized equities are better than regular way equities. Like tokens, a crass way to put it is tokens, ultimately well-designed tokens are equities on steroids. Like equities are just ownership on some ledger. If you can ultimately give that instrument superpowers, which is programmability, then you can do a lot more with it that you can do today.
All right, guys, I've got a really special episode for you today. We have Pranav Kanade. He is the portfolio manager for VanEck's digital assets alpha strategy. He is deep in the weeds of crypto. He's thinking about Bitcoin, Ethereum, all the altcoins. He's got some thoughts on meme coins, regulation, what are going to happen with stablecoins, and much, much more. I really enjoyed this conversation because it is very rare that I get to talk to someone who's thought deeply about so many different topics across the industry. Pranav and I spent a ton of time talking behind closed doors, so I'm excited to get him on the podcast and have you all listen to some of his thoughts. Go check him out on Twitter at VanEckPK. Or let us know after this episode what you thought. Here is my episode with Pranav. I thought a great place to start this conversation is there is trouble in the water in crypto. One of the things you and I have talked about is there's a bunch of these low float, very high FDV tokens that are out there, maybe even high hype as well. The Bitcoin maximalist would be like, it's Bitcoin and nothing else. The crypto people are like, you guys are absolutely insane. Look at all this other great stuff that's going on. Are altcoins all going to crash? Is this all going to be zeros?
I don't think so. I think that's like there's a lot of nuance in all of that. The way I articulate it to people is Bitcoin's probably the only asset in crypto that's achieved like true product market fit. It's like 300 to 400 million people in the world own Bitcoin, whether on some centralized exchange or a self-custody wallet. There's 5 billion people with the internet connection. So you're saying, you're kind of getting to like 8-9% of internet penetration there, which is to the point where you can say, yeah, like this is true product market fit. Everything else is just a broad experiment, right? It's kind of an extension of this idea that you can build applications on these public ledgers, and ultimately that's supposed to enhance the user experience, but also create a better, faster, cheaper version of what already exists in the traditional world. So it's kind of recreating a lot of those things. And that's still broadly an experiment in my view. So the right way to measure that in my view is look at the number of on-chain unique wallets interacting with these blockchains. That number is probably like 30 million monthly active wallets. Again, relative to like 5 billion people in an internet connection. So the entire asset class outside of Bitcoin is purely a venture asset class. And I started following the space outside of Bitcoin in 2017. And if you were to ask me, what are the odds that this thing becomes mainstream one day, I would have said 5%, because it was all just a bunch of white papers then. If you asked me that same question in 2020, 2021, I would have said 25, 30%. And you could have said, yeah, it's maybe DeFi, NFTs, gaming, something's there, and something unique will come out of it. Today, if you ask me, I think we're close to 50% that this thing goes mainstream. So the odds are kind of interesting. The question is, what is the next domino to fall in terms of product market fit and adoption? My opinion is it's stablecoins. No, it could be DePIN, it could be SocialFi, it could be some of these other things that are kind of interesting, but I think it's really stablecoins because it essentially has the buy-in from all the constituents you need to get something to go mass market. To be specific, it's more like US dollar stablecoins. So my general view is for a variety of factors, that's the thing that's going to take us from, let's just say, 30 million monthly active wallets to hundreds of millions. And any project that is somewhat adjacent to the stablecoin adoption story will do extremely well. So if you're looking at the altcoin universe, you want to focus in and around that theme. And then everything else becomes kind of idiosyncratic bets around sort of what they're trying to build.
So let's talk about stablecoins first, which I was blown away. I looked at the Tether transparency report, that they have on their website.
Yeah.
The US dollar stablecoin is like 100 billion or 110 billion or some massive number.
160, I think.
The euro, I think 160 is all of them combined.
Yep,
and so just the Tether US dollar one
Tether, okay.
was, call it 100 to 120 billion, something like that.
Yep.
The next biggest one that Tether has, according to this website, the euro stablecoin is 30 million. It's the difference between like 100 plus billion and 30 million.
Yeah.
And I was like, wait a minute, is this a sign that like the free market has spoken and people globally, when given the frictionless experience, if I could switch between any currency in the world, they all want dollars.
Yep.
Right. And so obviously that's great business. Like, Tether's printing cash, USDC and Circle are printing cash. But man, it does not seem like there's a lot of demand outside of a US dollar stable coin. And so all of these other ones, are they just, they're cute? You got to kind of be doing something else other than this dollar stable coin, but really it's the dollar stable coin or nothing?
I think so. I grew up in India, in Bangalore, and, my parents are doctors. So, kind of grew up around, let's just say, upper middle class. And everyone aspired to have dollars or have some amount of their net worth stored in dollars because, it was a diversification away from the rupee. And I try to go back to India every couple of years. So I went back in December. And I was hoping to run around and see folks say, we want some Bitcoin, because the Indian rupee to the dollar has kind of gone from like 50 something to 80 something. I haven't looked at it recently, but so it has devalued against the dollar. And you would think that people want Bitcoin. No, people just want dollars, right? People feel like it's been this bright and shining star out there for a long time. People feel safe in it. It's just very hard for the average user, even in like a country like India that has a pretty high internet penetration, to get their hands around dollars. And I would imagine it's very similar across the globe. And so US dollar stablecoins is one that I think has product market fit for a broader audience than even the number of people that have Bitcoin in variety of these countries, in a bunch of these countries.
What's interesting to me is if that is true, right, which all the data is suggesting US dollar stablecoins are going to continue to proliferate, the dollar is going to strengthen and Bitcoin's going to strengthen. So this whole like Bitcoin is going to succeed and the dollar is going to fall at its feet appears to be wrong.
Yeah.
Actually, it looks like the dollar is going to be stronger, Bitcoin's going to be stronger, and it's every other currency is going to kind of be the ones that fall because the people who want fiat are going to go to the dollar. It's great for medium of exchange, all this stuff. Bitcoin obviously is a great long-term store of value. And so then it starts to open up this question of like, okay, well, if the dollar is going to continue to get stronger, we can talk about China and Japan used to buy 22% of all the debt. Now they're buying 7%. Paul Ryan came out with this recent op-ed and he's like, wait a second, guys. There's a net new buyer of the treasuries, which is these dollar stable coins. But what I found even more interesting than just like they're buying a lot is Circle and Tether are not interest rate sensitive. They are going to hold the treasuries, whether interest rates are at 5% or at 1%. That's what central banks do. They don't care what the interest rate is. They're not doing it for just the yield. Whereas a lot of the institutional investors who've been buying a lot of this debt specifically from China as they're offloading it, et cetera, they are super interest rate sensitive. And so in a weird way, the stablecoin issuers are not just great because they're showing up with new demand, but they're going to show up with new demand and they're going to hold the treasuries regardless of where interest rates go, right?
100%. And what's most interesting about it is, if you look at world GDP, 60% of it is driven by consumer. And if you look at another dissection of it, the US is 25% of world GDP. So like 75% of world GDP is like all these countries outside. And a lot of that is consumer. That consumer around the world has not had an easy way to buy dollars. And essentially, if you're able to distribute to those people are not interest rate sensitive buyers, as you put it. So which is like fantastic for the US government to want this product to succeed because, actually the Federal Reserve put out a report yesterday or 2 days ago that I was reading, which is basically around this topic of the Fed's been reducing its balance sheet. Who's been the marginal buyer? And it's like basically like households, broker dealers, to smaller extent hedge funds, and pensions and those types of entities. Now, all those guys ultimately are interest rate sensitive, right? If all of a sudden the Fed cuts, the households that have been buying T-bills are going to rotate out those T-bills into equities or something that can give them a better return. To your point, the stablecoin issuers are not interest rate sensitive. They have to park it somewhere. And they can't go buy stocks with that capital. They have to buy it by short-term government bonds or government bills. So I think it's like a really good thing for the United States, which goes back to kind of the original point, which is, the U.S. regulators / politicians / government should like this. Merchants should like this because it, gives you a way to reduce your costs. Like, you don't have to use the credit card rails, banking rails anymore. Stablecoin rails are cheaper. And consumers outside the United States also should like it. So it's kind of got this win-win-win sort of construct. I think the reason stablecoins haven't taken off, right? And when I say taken off, that 160 billion of total dollar stablecoins hasn't gone to like tens of trillions already, is because there's been this hesitance by merchants from accepting stablecoins to some extent. So like if you just, talk to the big e-commerce players in the United States, e-commerce is like $1 trillion of like 7 trillion of US GDP. You ask them like why aren't you taking stablecoins for payments, or why aren't you trying to figure out a way to make this super user friendly so that people pay you in stablecoins? The answer often is like, well, we don't know how the US regulators feel about this. We don't want to get caught. Like our core business is like, e-commerce. We don't want to get caught up in this crypto regulatory crosshairs. So if you can change that through like what's happening in DC these days, then I think you can see this kind of big hockey stick adoption curve on this.
Yeah. Now, what becomes more interesting is can the stablecoin issuers collectively become the single largest holder of treasuries? Like they're, I think, 15th or 16th on the list right now.
Yeah.
Paul Ryan, the former House Speaker, in this op-ed, he said if they were a country, they'd be the 10th largest country.
Yeah.
But man, the trend seems to be going in their favor.
Yeah.
And so if this stuff becomes, $1 trillion, $2 trillion market cap,
yeah,
they probably are going to be, top 5. But there's a world where Circle and Tether are the largest collective holders of treasuries in the world.
Yep. And that's definitely possible, right? And it's also probable. What's more interesting to me is then extending that question a little further and say, okay, let's say stablecoin market cap, again, dollar stablecoin market cap is a couple of $1 trillion. That would imply that we have tons of on-chain users, that 30 million is 100, 200, 300 million. All those people have a bunch of stable coins in a wallet somewhere. And at some point, those people will want access to financial products. The only real available financial products for someone with stablecoin today is either money market funds with, BlackRock and Ondo and a couple of these other issuers, or the other extreme end of the spectrum, which is like altcoins and meme coins, right? You need some assets right down the middle, which to me is tokenized equities. So like I could see a world in the next couple of years where, someone in an emerging market or a developing country has a self-custody wallet with a US dollar stablecoin, and then is now choosing to asset allocate and is asset allocating to, US credit and also like US public equities, right? I would think that if you were to tell people in, Turkey, Argentina, India, Vietnam, that they can all of a sudden very easily own Apple stock, like I think they'd want to.
Now, do you think that they want that over dollars though? Like one of the things that I keep coming back to is in US equity markets today, and people get really upset when I say this, but I don't think that the historical valuation metrics really matter as much as they used to. Right. And so why is that? Well, there's a lot of people who are saying, this inflation thing is a big problem. I'm going to actually buy stocks because they seem to go up when inflation is high. And so now I am not just buying it on the pure fundamentals of like, what is this business worth? There's this like monetary premium that starts to get assigned. And so when you look backwards over the last 50 or 100 years, you're like, oh my God, the stocks are so much higher than the historical valuation. I'm not saying that valuation doesn't matter, right? It definitely matters. But what I am saying is like, maybe there's like a 10 or 20% lift in terms of, yes, it is actually still valued at the same plus a 10, 20% monetary premium. And so it looks elevated, but the holder base is shifting. And so like, that is like the quote unquote new way to value these businesses. But I don't know. How do you think about it?
So I think it all depends on the marginal flows of capital. So I think stats are that 70 to 80% of shareholders in any public company is institutional, and the rest is kind of retail. And obviously there's extremes, right? GameStop is probably largely retail. I think if you can look at the Tesla vote from last week, it tells you how much of Tesla shareholders is retail versus institutional. I think it was like a 45% retail, 55% institutional like mix. But also there's a shift going on underneath, which is the boomers have all the money, and over the past decade or two, the boomers have chosen to allocate via passive like ETFs. But as that wealth transitions from the boomers to the millennials and the Gen Xers, I think that's the generation after us, right? How they choose to allocate might be different. They might say, I don't know if I want to go buy a whole bunch of ETFs. Like, I'd rather just own Elon companies because, Elon creates a ton of value. And like they might be indifferent to the S&P the earnings multiple of that stock. This whole like framework around free cash flow based valuing assets is something that I think is something that is trained, or that the existing set of folks that drive the capital markets are trained with, but the next generation might not think about the same these assets the same way. They might sort of think about it very differently.
And if we then take equities, we have stable coins, we have kind of the Bitcoin story, this idea of mix between retail and institutional. When the ETF got approved for Bitcoin, I think everyone thought it was institutions. Now there's some data coming out that suggests maybe it was actually majority retail.
Yeah.
We saw recently commentary from someone at BlackRock. Actually, I think it was the CIO of the ETF and indexing business there was like, no, it's 80% retail investors, 20% institutions. That number blew my mind, right? The estimates
it's like
are
self-directed brokerage. People go to their Fidelity account.
$16 billion was floated into these products. 13 billion of it, they were saying, is, depending on each estimate. Some people say 80%, some say 13 billion. Some people say, another way they're measuring it is like on-chain Bitcoin that is actually moving into the ETFs. And really just the idea is like way more retail is buying the ETF than institutions or than what people were thinking.
Yeah.
Is that a positive or should we be concerned? Like actually, are the institutions not coming?
I think our view was that it will take time for the institutions to come, right? These channels need to, they have their own internal processes to then approve these products and then try to think about, how does it fit within like sort of an asset allocation framework and then ultimately then recommend these things. If you just think about like the incentive structures at these wealth manager RIA channels or whatnot, the job is to not get fired, right? So like the way you get fired is you buy some asset for your client at some high price and it draws down and then the client is like, why did you buy this from me? So I think that channel takes time. What's interesting about the quantity of inflows and where it's come from being retail, I think there was like an interesting reflexive trade that got set up, which was you had a whole bunch of like things that kickstarted the ETF inflows, call it people like larger crypto funds that own Bitcoin that said, we'll swap our Bitcoin for the ETF. That created some inflows. At the same time, you had a bunch of like model portfolios that said, for our model portfolio, 1% allocation makes sense. And then that created sort of this buyer that is not as price sensitive. So like model portfolios, when they decide they want to have a 1% allocation, they don't care if they're buying it at 43K or 44K. They just need to get their allocation. So those were like the first movers. And then as those inflows were coming in, retail was like, well, there's this nice tailwind right now. Like there's a whole new buyer base coming in and all of retail or a big chunk of retail came in, right, to chase that flow. And that created this reflexive feedback loop. So new retail flows that tracked essentially model flows and that kind of like fed itself. Is that a good thing or bad thing? I think it's net good. The question is all the retail flows that came in, is it replacement flows? Like did people sell spot Bitcoin and then go buy the ETF or is it in addition? We don't know that. Price action would tell you it's probably an additional flow rather than a cannibalizing flow, but that's kind of my guess. What do you think? You're a Bitcoin guy. I'm curious.
I think that retail definitely was buying. I think that there is net inflows for sure. I think that I was surprised by how much was retail versus institutional. I agree that it will take a while for the institutions to start allocating. I also think that institutions chase even more than retail does. Retail is very undisciplined, and so if price starts to run, they're like, "Oh, I can't miss this," and they go in and it further perpetuates it. But I think institutions are not immune to that either. They may be worse. And so if we go through the summer and Q3 maybe and prices are flat, and then all of a sudden we get a Q4 and in Q4 prices start to run. I mean, there's a world where all the institutions start piling in, which is what we saw in end of 2020 into 2021. People were just using the grayscale GBTC ARB trade. And so right now there's a lot of people piling in, but when I look at the net inflows, one of the other things that's interesting is there's a lot of basis trade going on. And so you've got, one side, if you just look at the net inflows of the ETF, but you're not looking at the short interest. And so I think some of that's happening as well. So it's fascinating to me, right? It's like they approved a product that everyone wanted, $16 billion floated into this thing. Bitcoin's up, call it about 50% or so since then. And people are looking at the data now and they're like, oh, none of the people that we really thought were showing up are here yet. And so the question is like, are they going to come? If they come, then that'll be good. If they don't, maybe that's a bad thing, right? Maybe actually we wanted them here and we should be concerned.
Yeah. The other thing that I found relatively interesting was, so we're a global business. I travel to Asia a fair bit. I was in Singapore, Hong Kong, meeting family offices, private banks, those types of entities in September of last year. So before any of this really happened. And I went back in January. And the biggest change I noticed was the first time I went, talking about crypto was very hard. It was kind of like nobody was like that interested in talking about it. Any given like asset manager, whether small family office or multifamily office, it's always one of these things where like you have like 3 or 4 decision makers. One person loves crypto, and then 2 kind of are like, I don't really care about this, and 1 person hates it. So for the one person who loves crypto, talking about crypto is very hard, and convincing the rest of the team for an allocation into the space was also very hard. When I went back in January, what I could see, and this was with a different set of allocators, was that the one person that loves crypto had like this ammo. Like, look, like the Bitcoin ETF has been approved. The US has given you a green light. Like, we got to do something. Mm-hmm. And it was not only that, it was like the person that hates crypto and the 2 people that don't care, they were also like caught off guard. Like, it was almost like this unexpected positive. Mm-hmm. The details of how we got here didn't matter, which is like, oh, we had to litigate to get here kind of thing. But it was just the fact. So I imagine there's been a ton of flows that has come out of different parts of the world beyond just the US.
Let's talk about Ethereum. Obviously, with Ether, I think there's been 2 things. One, it looks like, and they're now talking about the fact that they're going to approve an Ether ETF at some point. It looks like it'll happen sometimes later this summer, kind of July, August timeframe. And then Consensus recently came out and said, hey, we filed this lawsuit against the SEC. We've asked for clarification. They have let us know that this investigation around Ethereum 2.0 is finalized, and it looks like Ether is going to be classified as a commodity, not a security. This feels like a way bigger deal than people are even making it. Yep. People are making it kind of a big deal, but this feels like, oh, wait a second. There's a lot of worldviews, a lot of frameworks that people had that just got shattered because ETH is not going to end up being a security. Yep. And so talk a little bit as to, was this an expected thing? And then what do you think those ramifications are?
Yep. So I know everyone is excited about potentially spot ETF and all these things, but I think there's something bigger happening here, right? Like the entire world that assumed that this ETF might not happen. And at this, like, while like this ETF approval process and this consensus thing is happening, something else happening in DC, which is obviously Trump came out in kind of full support for this asset class, which during his administration, they weren't as friendly to the space. And then that had a bunch of Democrats in the House kind of reevaluate their own positions on this thing, especially the ones that have to potentially get reelected in November. So, so what was interesting to me is like the accounting bill, SAB 121, had basically, I think, like 21 Democrats in the House vote in favor. And, some folks in the Senate, which obviously Biden ultimately vetoed. And that was like kind of a interesting, nice bill, but it wasn't as important as the FIT 21 bill that passed the following week, which had, I think, 71 Democrats in the House. Like there was an exponential growth in the number of Democrats supporting a more impactful bill, which is, I guess, like a crypto market structure bill, right? So I think there's like a wholesale shift happening here where crypto went from sort of this, 3 months ago, we were like this kind of like abandoned asset class that we had no idea who really supported us. And our assumption was we're going to have to fight through the courts to get any amount of clarity. And all of a sudden we became this sort of like, or we're becoming this like asset class that has some bipartisan support to allow us to exist and allow the good projects in the space to thrive. So that's what's, I think, really happening. And the ETH ETF is potentially one manifestation of that, but it's not the main thing. So I think it's interesting to kind of look beyond it, right? So if ETH is not a security, it's a commodity, what does it say about all the other L1s? I don't know. Like, because theoretically, I could make the case that there's some L1s that you and I have talked about that are better technical solutions to solving this problem of how do you onboard hundreds of millions of people to use these blockchains and ultimately, have these things scale. And we can make a case both ways that, Solana is potentially a better solution than Ethereum and these L2s in some ways. So I think people need to kind of maybe zoom out beyond the ETF and look at what's shifting and what's changing.
People have been upset that are in the hardcore Bitcoin community because I've said, listen, when the facts change, you got to change your mind.
Yeah.
Right. It's a sign of intelligence.
Yeah.
They're not going to be securities.
Yeah.
They are going to be commodities, as we're seeing. There's going to be ETFs. Altcoins are going to come to Wall Street. Again, whether you like it or don't like it, you agree they should or not.
Yeah.
That is all the data we have right now is that is going to happen.
Yeah.
And then also, if you are in those investor kind of capital allocator seats, you better get up to speed.
Yep.
Because there's a lot of people who I've known for a long time who said, oh, it's going to be Bitcoin. And now I got to decide, do I put on Bitcoin exposure or not?
Yep.
All of a sudden, it looks like, wait a second, there's this very large investable universe that I know nothing about.
Yep.
And so I can choose to just sit it out, just like I might sit out certain, sectors or kind of verticals in public equities or whatever.
Yep.
But if I want to find risk, because ultimately that's really what Wall Street's looking for is where can I take a lot of risk and hopefully get a large return for taking that risk. You're going to have to figure this out and you're going to have to get up to speed, not just now on Bitcoin and ETH.
Yeah.
I don't know how far it goes down kind of the coin market cap list, right? But it's not the first two.
Yeah.
And maybe it's not the first 100,
right?
But if it's 25, that's a pretty big investable universe that people, got to start.
Right.
And if you look at how much work they had to do to get comfortable investing in Bitcoin, I mean, this is years, right, of work ahead of these people to get up to speed on everything else.
The only kind of quote unquote counterpoint to that is that a lot of these people have done the work.
You think so?
I've met a lot of them. I mean, so I think the big pools of capital really are the endowments, foundations, pensions, sovereigns. And I've met a lot of these folks, and there are always like groups within these larger organizations that have done the work, that have made the internal case, but have been derailed, let's just say because of FTX and all these things.
But what have they made the case? They're making the case for Bitcoin, they're making the case for Ethereum, are they making the case for number 10 or 12 on the list?
So they've made the case for digital assets, and they've then allocated to venture funds in the space because they're terrified of the mark-to-market of this stuff, right? Because again, it all goes back to like incentives. So like if you think about these large organizations, the people who like crypto, they don't have an incentive-based compensation structure. They make X no matter what. Their job is to stay in that job for 30 years and sort of collect that check. So it's only downside. So crypto is just like this controversial topic. So if you have an investment committee of 10 people in your XYZ pension, there is no real economic upside for you to go in there and say, allocate to this right now because there's great returns to be had. Because what's going to happen is you allocate to a liquid token strategy of some sort, and all of a sudden that strategy goes up and down 25%. This person has to now sit in front of that group of people and explain why that is happening. And that's too much work. So they've all kind of chosen to allocate to venture because you don't have to deal with the quote unquote mark to market, and you don't have to explain to someone what a token is, right? It's like you kind of just say, well, it's like Andreessen or whatever, it's venture fund. It's easy. So that's all they've all done. And it actually shows up in the market structure of crypto, right? How many times have you heard of a project that's a copycat of what already exists in the token market that is raising a round at a premium to where its comp trades? I've seen that so many times, and you're like, why does that happen? And it's because the venture community that raises these locked up vehicles has too much capital. And the liquid token market, which is kind of your exit market, is all retail. There's no real institutional capital there because like the allocators aren't allocating yet. That will have to change at some point.
Why?
Otherwise, you'll have what's happening in the altcoin market today, which is projects launch, the same issue of like low float, high FTV, and the venture guys that wrote the seed check, which again is the downstream capital of some pension fund, has vests its tokens 12 months out, and there is no buyer. Like, who's the buyer? Because you have to just look at the supply demand imbalance between the size of the altcoin market and the amount of supply that's coming as a result of all these new tokens launching that are venture backed tokens. So that imbalance has to change, right? I mean, you kind of have this, you have this like to draw a comparison to the traditional market. The venture capital market in TradFi is much smaller than the size of the public equity markets, right? That's you need that type of a market structure in the token market as well.
Is if you believe markets tell the truth, is the lack of public market crypto, like liquid, hedge funds, et cetera, capital telling you that outside of some small subset of the coins, most of them are not worth anything?
Yes.
And so basically the venture capitalists are able to generate from 0 to 1.
Yep.
But nobody is willing to say, I'm going to stake enough money on 1 to 10 as an opportunity. And so that's why there's the lack of capital there. Today's episode is brought to you by CrossFi. CrossFi is the Apple Pay for crypto. For the first time in history, anyone with a Web3 wallet like MetaMask can spend crypto through a physical or virtual Visa card anywhere in the world where Visa is accepted. No more exchanges or middlemen. Just link your wallet, get your card, and start spending today. CrossFi card transactions have already been successfully processed in New York, Los Angeles, London, Dubai, China, Japan, and over 20 other countries. Be one of the first to get your hands on a CrossFi card and a prize pool of up to $3 million by joining and participating in their testnet today. You can go to xfi.foundation/users. Again, that's xfi.foundation/users. Go check it out today.
That could be it. And the other thing I will also say is like, pull up all the venture funds in crypto that have been deploying capital, let's just say since 2017, and compare their TVPI to DPI. How much of that actually distributed, right? Mm-hmm. There's some that have distributed a lot, right? That, I'm sure you and I are LPs in, but a lot of them have like all these great paper like returns, and none of them have really distributed because they can't actually exit these things. Like either there's no token yet for the project they invested in, or there is a token, and even though the quote unquote market cap of that token is higher than where they deploy that capital, if and when they try to exit that position at that market cap, they're gonna like crush the price because the order books are super thin. Like we look at these order books all day. Like most of the altcoins, there's not that much liquidity. So
like, what do you think is the average liquidity on kind of a average altcoin?
So if, I don't know, the top 50 altcoin, if you try to sell 5 to 10 million or something, you will move the price probably 10, 20%. Mm-hmm. I would say like, let's just say token number 30 to token number 15 coin market cap. Mm-hmm. If you try to sell tens of millions or something, you will meaningfully move the price. And so like a lot of these venture funds that even have a liquid token on their investment portfolio that has come as a result of an exit or as a result of a token launch, those things to me are like not, great reflections on how these venture funds have performed because they actually cannot DPI that.
Mm-hmm. Basically, it doesn't count till you sell it.
Yeah, it doesn't count. Right. You can't count. Exactly.
And what are you seeing now with a lot of these high FDV but low float? The low float part, I think, is actually one of the most interesting things that you've told me recently, which is if I have something that is a $1 billion market cap, but the FDV is actually, I don't know, 5 billion or 10 billion, right? There's still 80 to 90% of the tokens have not entered the market. How do you see those tokens entering the market if they ever do? And then what is the impact? Do you just need $5 or $10 billion of capital, or how do you think about like a way where those tokens can enter, you can get a higher float percentage, and these things not get destroyed?
Yeah. So as the current market structure holds, there's only one way to support all those tokens hitting the market, which is Bitcoin whales have to sell their Bitcoin and go buy that, right, to support that price, or money has to come in from the outside. So again, the pools of capital we're talking about, they have to decide they want to allocate to token strategies, and those token strategies have to then buy those tokens at a substantially different price, right? Neither of those things seem to be happening. So, just taking a step back, most tokens draw down 90% after they launch. Like it's just a matter of when. Because, most of these tokens launch with some airdrop campaign, give some tokens away for free. And then they have a 6-month lock. And at the end of 6 months, or 6 or 12-month lock, depending on the project. And at the end of the time, the original venture investors that wrote that seed check and the team and founders that worked on this project start to vest. And on paper, they've all had this massive wealth creation event. And, then it's like, they're all kind of looking around and saying, who's going to sell first, right? And someone's going to start selling, and this thing goes down 90%. So in our view, the sweet spot to invest in token projects is like 18-ish months after they launch, because that's when you've kind of had this boom and bust. And then you can look at it and say, okay, is the original team and founder still focused on building this, shipping products that people want to use? And is the thing gaining traction? Or is it kind of just going to fizzle away to zero over time? 99.5% of these token projects will kind of fizzle away to zero, because what happens is most of these founders in crypto are generally low quality, and they're all in it for like sort of this get rich quick scheme, which is what a lot of these things are. And they will, vest some of their tokens, and even if they've only vested 10% of their tokens, that's like a couple $1 million for the founder and the team, and like they'll cash out and they'll go do something else, right? Like why like live through this like brain damage of like having to ship products when like your retail holder base that is in the token is now like really angry at you because it's drawn down 90%, all this stuff. So most of these projects will go through this like hype cycle, like this boom and bust, and then will sort of slowly fade away to irrelevance. There'll be some small cohort of projects that continue to ship through that painful time and make it on their side and have become like a great project. Obviously, ETH was one of those. I think Solana was one of those, right? Solana went through its boom and bust. And there are going to be several others that go through that. So one of the ways we approach it is we're excited about all the crazy things that are launching, right? In the last 6 months, we're going to meet those founders, meet those teams, and understand what the roadmap is and what their kind of vision is. And then we'll evaluate it 12 months from now when they've drawn down 90%.
What about the meme coins? Like it feels like on one hand, it's insane, like complete waste of everyone's time, almost entertainment to some degree, or like gambling or something.
Yeah.
On the other hand, this idea of like a fair launch, a token that plays into some theme or some trend on the internet. Some of these are starting to get like real market caps, and because 100% of it's out there, it tends to be fairly real. So how do you guys think about that, or how do you evaluate them?
This is actually one I want to pick your brain on a little bit, but when Bonk and Whiff and all these other meme coins were kind of playing out in the second half of last year, first half of this year, my view is, look, like this is how like the younger folks like to gamble. They don't want to go to Vegas. They don't want to go to like casino and then play blackjack or whatever. They would rather just engage with their friends in the social, like guess the next meme type thing and then gamble on that. What's been interesting to me recently has been observing what some of the quote unquote influencers slash like celebrities are doing. It's only interesting because on the one hand, you have this other one theme here, which is how products are discovered has changed from like people watch ads on TV to then like search-based ads to then social media-based ads to now like this creator economy-based way to product or discover product. And a lot of creators have realized, look, my flywheel is I build a core audience that trusts me and trust what I'm saying. And, I'll either partner with an existing brand or launch my own brand and launch my product. And then I will monetize that product by selling it to my current audience. And then I will reinvest all those profits into making more content. Like Mr. Beast is like the great example, right? He's got this like chocolate bar company or what's that energy drink that Prime, yeah. And if you look at like sort of the growth curves of those like influencer launch brands, it's way faster than like what Pepsi and Coca-Cola can launch or Hershey's can launch, right? That's kind of interesting to me. And then I think about these creator tokens and I say, can you kind of pair the two? Can you also let your audience in some way participate in the success of the products you're launching? Again, you need a regulatory framework to allow this, but could you have a token that accrues its value from the products that creators launching and really not only buy the product that from an influencer you trust, but also participate in the financial success? So the first experiment we saw with this was, so Iggy Azalea's like mother meme coin, I believe can be used as a token to pay for the cell phone plan that she launched last week, right? Obviously, like, people would rather just pay with fiat if there's no benefit of paying with a meme coin, but you can start to see how that experiment goes further, right? If like that token has some value that comes from the cell phone plan itself.
Describe a little bit about what she did. I think there's a lot of people who don't even know this happened to probably watching this.
So I'm not deeply in the weeds of like what Iggy Azalea is doing, but from
me either.
Yeah, my basic understanding is like she's got like 7.5 million followers on Twitter. People think she's like this authentic artist. She launched a meme coin called Mother, which clearly has no value, but it seemed like she did it in a pretty authentic way. Like she was hosting Twitter spaces and speaking about crypto and engaging the Solana community in a very native way where she was demonstrating to people she understands what the stuff is about. She's not just here for some grift. And that sort of garnered this massive audience. And I think a week later or so, she launched essentially what looks like a cell phone business. So I don't know if you remember a couple months back, like Ryan Reynolds sold Mint Mobile for like $1 billion something. that business model is pretty simple. Like Ryan Reynolds has an audience. He can sell cell phone plans probably cheaper than some of the big telco, but he's like leasing everything from the telcos, right? It's called an MVNO. So he doesn't own any spectrum or cell phone towers or anything. He's just a customer acquisition wrapper around, like, it's like a white label thing for a cell phone plan. I think Iggy Azalea launched something similarly, but the nuance being you can pay for your cell phone plan with the meme coin, which on the surface, you're like, why would anyone want to play with the meme coin? And that's true. But you can kind of use your imagination and say, well, what if that meme coin got some of the profits from the mobile business? Probably becomes a security at that point. Again, I don't think our securities laws would allow this, but you could see how this evolves. If the regulatory regime changes, then isn't Mr. Beast better off monetizing his quote unquote equity through a token rather than trying to IPO his business one day, right? It's a better way to like connect with your direct audience.
Is that where the world's going? You think that it's all going to be tokenized equities?
Yeah, I think tokenized equities are better than regular way equities. Like tokens, a crass way to put it is tokens, ultimately well-designed tokens, are equities on steroids. Like equities are just ownership on some ledger. If you can ultimately give that instrument superpowers, which is programmability, then you can do a lot more with it that you can't do today.
Yeah. And part of it is right now we use the dollar as like the common unit of account. So if I have Amazon stock and I want to buy a house, I go from Amazon stock to dollars to the house. There's probably a world where I just go from Amazon stock to the house.
Yeah.
Right. And that, although that's a very simplistic example, you can imagine, I can go instead of from mother token to dollars to cell phone plan. I can just go mother token to cell phone plan. And so I do think it becomes pretty interesting because it's almost like merging these equities with currencies, but also almost like airline miles or something, right? And so in a weird way, like airline miles do serve this purpose today, is you can buy things. Although I didn't know this, I have held on to almost all of my airline miles, and I was like, I'll look at my airline miles. I can't wait to go, get more. And someone's like, that's like one of the most inflationary things. Is no matter how many airline miles you have, you basically have $1,200, right? Like you can have 100,000 miles or 1,000,000 miles. Somehow it's always like $1,200, right? It's just enough to maybe take a domestic flight, but not like a really far flight. And so there are elements of this that we've already been experiencing. I think what's new here is now you can go and take the equivalent of those airline miles, and there's a ticker.
Right.
There's a price.
There's a deep, transparent market.
Yeah, and you can sell them.
Yeah,
you can sell them.
Yeah, you can sell
right?
them.
Yeah. And I do think that there is something really powerful about the fair launches. It takes away a lot of the critiques from the Bitcoin community. Because now you're saying, well, wait a second here. If somebody launches it and it's available for anyone, and everyone is putting the same money in, sure, the people who launch it know about it, right? Other people don't. But that does feel fairer, right? Maybe it's not the perfect thing, but it's fairer. It definitely seems like that helps in terms of it not being a security and being able to be used for these other things.
I actually have a slightly different take on this, which is a lot of like the crypto world has optimized not only their product roadmap, but also how they run their quote unquote business and how they use a token for this idea of not being a security, right? And I think then it's like this convoluted like thing that like most of the world doesn't understand. Like, I'll give you an example. So like I always found the Filecoin project interesting. Like I spent a lot of time trying to understand Filecoin's tokenomics, and it's like gives me a headache. Like good luck trying to explain like a TradFi person how Filecoin works, right? And then you're like, well, like why is this so convoluted? Like the business model of Filecoin is simple, which is you have a set of data centers that are plugged into a storage network, and those data centers can be used for essentially what looks like a decentralized storage network. Money should come in, money should go out, right? And it's probably this convoluted because they're trying to, avoid being a security and trying to be a commodity. I get it. But I think the world's kind of heading in this other direction, which is at least FIT 21, which passed the House, establishes that there's only two types of assets. There's obviously crypto commodities, and there's essentially, I think they called it restricted digital asset securities. And everything is probably a restricted digital asset security outside of, maybe a handful of tokens. But that's not a bad thing. It just means that you have a set of reporting requirements as a project, and you have the ability to then decentralize and become a commodity one day. But you don't have to, because like for certain businesses, like running it as a centralized organization makes a lot of sense. Like imagine if like Elon had to decentralize SpaceX. It just makes
Or
any
Amazon.
sense. Yeah.
And the entire point of Amazon is efficiency.
Yeah.
Right. If all of a sudden it was a decentralized Amazon, it wouldn't be effective. Yeah.
It just
100%.
wouldn't work. Nobody would use it. The
Yeah.
product experience would suck. So some projects might choose to, remain somewhat centralized and be this restricted digital asset security. And obviously, like in this bill, all the exchanges that list these tokens also have to register with both the SEC and CFTC. And projects they list on their platform has to fall within one of those two buckets. So like an ambiguous, weird project that tries to like straddle some gray lines won't get any listings. Market makers won't provide liquidity for it and will not exist, right? So I think where the world is going is sort of this sandbox or commodity world, and so that will then allow folks to really play around with the creativity around how to grow their businesses faster than they normally would.
Mm-hmm. Let's talk about Trump and Biden. They seem to be in a chess match. Maybe it's checkers. I don't know. But there's a little bit of like Trump makes a move, Biden makes a move. Trump makes a move, Biden makes a move. I think Trump seems to be all in on supporting crypto at this point. I mean, every rally, it seems like he's talking about, I will protect you against the Biden, war against crypto or whatever.
Yeah.
Biden seems to be becoming, more sympathetic. The administration seems to be kind of loosening up a little bit. Do they end up in the same place? Is it just like now all politicians are going to be pro Bitcoin and crypto, or do you still think that we may get kind of, one side of the political aisle being anti-crypto and they cede the point to the other?
I don't know. But I do think a good outcome would be if this was bipartisan. And I think that's where Congress generally is. That's where the House definitely is. And that's where the Senate seems to be going, right? Like the version of the FIT 21 bill that's in the Senate is the Lummis-Gillibrand bill. That's a bipartisan bill. So if Congress kind of ends up there, then I don't see why the White House should have a very different opinion. So I could, the tinfoil hat speculative guess is like this is kind of like this Elizabeth Warren far left type view. To the extent the Biden administration can get away from that, then I could see how this is just a bipartisan thing. Mm-hmm. And that in the long run is probably a good thing, rather than having to like be like politically on one side of the party. I mean, just like, not to bring this into politics, but someone shared this Financial Times news article with me recently, which basically shows that young men are moving further and further to the right in their political views, and same demographic, but young women are moving further and further to the left. And I generally notice in my own marriage, like, I am generally center right, and I can continue to hold those views. And my wife is, center left, and we both are like kind of unintentionally drifting apart in some of our views. And I think that's happening across the country in many ways. And crypto is one of those issues, right? Like many of us in crypto are single issue voters, and it shouldn't be that way.
Why not? I think that's always been the case. I think people are full of shit.
Yeah.
When people walk into the ballot box,
yeah,
I think for decades, if not centuries, people have voted for their wallet, even though when they walk out of the ballot box, they say something else. Right?
Yeah.
Not everybody,
yeah,
but a bigger percentage of people than we probably would be comfortable with.
Yeah.
They ultimately are saying, who's best for me and my family's economic security? Who's going to help me make the most money from an economic policy standpoint, a tax standpoint, all this stuff? Yeah. And then who is going to allow me to use that money to grow my wealth, my financial security, et cetera?
Yeah.
And if you think some of the other issues are tied into that, even though they don't appear to be, like crypto is a good example of like crypto is that, right? But we just call it crypto. So I don't know. I just think that human nature is to be self-absorbed, right? And to say I'm voting not because of who I think is best to run the country, but who is going to be best for me. And it's pretty selfless. Like it's commendable to walk in and say like, hey, actually, I'm going to vote for somebody who's going to do something that's going to hurt me, but it's good for the country. Yeah. I just don't think that, we're like joking ourselves.
No, but I do think there's several variables in that question of what's good for my family and my kids or future kids. That question, right? Which is, on the one hand, there's like a very clear financial angle. And then there's like things like social issues and climate and whatever else, right? Everyone's got like all these issues, and you have to like make like this priority checklist. And we ultimately prioritize and say, this is the one issue I care about the most, and I'll vote based on that.
But that's what I'm saying.
Yeah.
I think people say that that's what they do.
Yeah.
But in my experience, what we have seen are the people who tend to check a lot of the boxes on the social side actually end up hurting, especially the upper kind of income folks on the economic side.
Yeah.
And so there are people who do it.
Yeah.
But I think it's a smaller percentage than the people who say they do it.
Yeah.
Because what they're ultimately doing is they're voting for someone who is going to hurt them financially for some other non-economic reason.
Yeah.
And that essentially would just argue that like market economics don't exist.
Yeah.
Right.
Well, let me reframe it for a second then. Okay. So let's just say you've accumulated a certain amount of like wealth. And at which point you'll say, is there a point where someone says, I'm willing to give up X percentage of my future earnings power if it means that I improve like the odds that, I don't know, if a nuclear war is a little less, right? Like I think some people would make that choice.
For sure.
Yeah.
It's just as many people, let's say 100 people say they do that.
Yeah.
I think it's 70. Right.
Okay.
And like 30% are just, they're morally like grandizing, or they're trying to like virtue signal or whatever.
Yeah.
And so what I think is really interesting about the upcoming election is like, I think it was David Sachs had a great point. He goes, we had an A/B test.
Yeah.
Right. We had like one president, then we had the second one, and now they're both on the ballot.
Yeah.
And I do think that there's a lot of people who are like, well, wait a second here. Either candidate is better for me and my financial situation, regardless of, which candidate and who you are. And it's fascinating to me because if you actually extrapolate it out to crypto, that's what people do on a daily basis, right? They're allocating their capital based on what they think is best for them financially.
Yeah.
And now you're almost getting this like weaponization where, the Trump token and the Bowden token or whatever have become a quote unquote prediction market to a degree, right? And so again, it's this merging, like as technology usage and penetration goes up, as the friction between all these things goes down, what's more accurate, the individual coins, the polling, or the prediction markets? And I don't know if we know the answer.
We don't know the answer,
right?
Yeah.
But there are now like 3 different data points suggesting readings on who is going to be the next president.
Yeah.
And we won't know till hindsight, but like you'll be able to look back, and somebody should go do this who's smarter than me and say, okay,
right,
in the 2 years leading up to it, here's what each one of these metrics said. Which one ended up being more accurate?
Well, they're all 3 kind of saying the same thing at this point, right?
Now.
Yeah.
But for example, polling in 2016 did not predict with any degree of accuracy what ended up happening, right? 2020, I probably don't know enough of the details as to whether it was accurate or not.
Yeah.
The prediction markets, the coins is the first time we're going to have it, right?
Yeah.
Like, as you see this stuff play out, you're like, okay, well, what would it tell us if all 3 of them say Trump's going to win and Biden wins?
Yeah.
Right? Like all 3 are wrong.
Yeah.
And what if the odds change between now and November and the coins say that Biden's going to win and the other 2 say Trump's going to win? Like, there's still so much room to go.
Right.
So I'm just very interested in this idea of in a digital world, there's now more optionality for an individual, both in terms of data points, right? In this example. But you and I have also talked about there's now mirrored coins for equities.
Yeah.
So Reddit goes public. There's a Reddit coin.
Yeah.
Again, the coin should not be valuable, right? You don't have cash flow. You don't have assets. You don't have shareholder rights. Like all the things that make equity, valuable.
Yeah.
The coin went up more.
Yeah.
GameStop saw the same thing, right?
Yeah.
I'm sure there's a Tesla coin out there somewhere, right? Like you just go through this and you're like, okay, in a world where historically value investors have said, what's the downside?
Yeah.
If you remove risk from the market because they're always going to step in and print money and save the market, they're always going to bail out the banks and kind of do all this stuff. Is the question now like, how high can the thing go? Right?
Yeah.
That violates every timeless investing principle in the world.
Yeah.
But again, we now have choice. And so when you add choice, you go one of two directions. Either choice equals like, no, there's one choice and a bunch of stupid stuff.
Yeah.
Or we actually do end up in a world where there's multiple ways to play, these developments.
Yeah.
And I don't have answers, right? I just like, I'm watching this play out and I'm fascinated by the fact that now if I want to bet on Tesla's next earnings call and I say, I think they're going to beat on deliveries, I can buy a coin. I can do a prediction market on just deliveries. I can buy the equity.
Right.
Like I have multiple options now.
I think prediction markets are the end state.
Okay, explain.
I think most people want to make these very isolated bets on very specific things.
Isolated meaning I don't want to buy Tesla stock going into the earnings because I think they're going to beat on production. Right. I want to bet specifically just on production.
Yeah, even simpler. Like last week, for example, if you wanted to bet that Elon's shareholder compensation plan was going to go through, you want to make a bet on that single prediction rather than try and guess what the stock does the next day, right? It has so many different variables. It's just that prediction markets at scale hasn't been necessarily feasible until very recently, because the biggest problem is like everyone wants to create a prediction market, like who's going to provide the liquidity for it. But if you can then have this global ledger where liquidity can be provided by like your average Joe, because until recently, until DeFi, liquidity providers were the banks, right? Like the market maker or liquidity provider for any stock or bond or whatever are the big banks. So that market making function has been kind of consolidated to these large institutions. But if you can democratize that, where you and I can take our small little PAs and start providing liquidity and whatever we want to provide liquidity on, because we can earn fees because we think there's people that want to trade it, then we can be experts or domain knowledge experts in that one thing and provide liquidity in an intelligent way. So this market making function kind of extends and becomes this like open source thing. And so that allows a global prediction market to exist. And I think that's where we could theoretically end up at some point.
I do think that the prediction markets are drastically underestimated at the moment. And it is a story as true as time, where you continue to get more accurate outcomes, leads to liquidity, leads to participation, does all this. And so if you're able to say to someone, you don't have to bet on all the variables of the stock price, you can just bet on this one specific data point, specialization, right, becomes much broader. But also too, I do think that a lot of liquidity flows there, and it doesn't have to be cannibalizing, public equities. It can just be net new stuff.
Very different. Yeah. Because here's interesting. Like I started my career on a trading desk at UBS. And, there were like 8 traders. They all had big balance sheets. And the things they provide liquidity on, it was my job to have a fundamental view on it. So, because when you're providing liquidity for, especially in bonds, which is where I was, you might get stuck with the inventory, right? So you need to know what you're essentially providing liquidity on. That little function is not scalable across random prediction markets. So otherwise, you have to grow headcount massively. So banks and institutions cannot do that. But you, Pomp, can be an expert on very specific things, like because you're interested in that topic. And it might be that there are other people in the world that also want to make bets on those things. And so you might be specialized enough with some balance sheet to provide liquidity on something. And you might be able to aggregate liquidity from other people to expand your balance sheet to provide liquidity in that one specific thing. So that's, like, again, all of this is only possible because of public blockchains. And if someone's like, why do you need to care about things beyond Bitcoin? It's for something like this to exist one day.
Talk about fundraising. You've been fundraising for a couple of years now. You've kind of talked to all these different institutions, et cetera. What are some of the lessons that you've learned in those conversations?
That's a great question. I think the biggest lesson I've learned is don't sell. Because if you're trying to sell to someone, there's in their brain at some point they're like, what am I missing here? Right. I think generally I've learned to be authentic and be truthful and be transparent. So with all my meetings, I generally tell folks whether or not they have exposure to crypto. I generally start by telling them that I think there's a good 50% chance none of this amounts to anything. So they could lose a lot of money, because that's the truth. And then I also talk about all the potential negatives in the space, which is, I think because I come from the traditional markets, when you compare founders and let's just say outside of the crypto world, the quality and caliber is probably higher than the quality and caliber of founders in crypto. And so I generally try to give people the objective view, and because that's kind of what I do. I'm personally a pretty big investor in the space, including in my own strategy. So I try to be as objective as possible as an outsider looking in, and I give all the people I meet those facts. And then I try to build a relationship with them over a long time. And eventually, if they think they want this exposure, then they can come talk to me. That has seemed to generally be the thing that works for me.
Have there been any negative surprises in the way people think about the asset class or what they're worried about?
Well, I think what I maybe didn't fully grasp before starting this thing was like just how you have cold start problems in all networks. You have a very similar problem in this space, which is, if you want to get, like, let's just say the world of endowments, like university endowments, to deploy capital into token strategies, they're all kind of looking around and saying, is that guy doing this? Is the other guy doing this? Like, they're looking at their competitors saying, which of my competitors are doing this? And if none of them are doing it, there's no like real incentive to move and do something. But the moment one or two of those guys, deploys capital into the space and does really well as a result of that, then that really triggers like this huge wall of money needing to come in because they can't continue to underperform their competitor in some ways. So just the way you have, I think, cold start problems and, social networks, do have a similar-ish thing in the fundraising side of things.
Yeah, that makes sense. Where are we in the cycle of crypto? There's this kind of having bull markets, bear markets. Are we in a bull market? Are bull markets and bear markets going to go away? How do you think about it?
I always wish that these kind of cycles of booms and busts go away, but I don't think it's going to go away because you have such a large retail base in the space, and retail often behaves very differently than institutions do, right? Institutions never want to like buy the new all-time high. They always want to find value, quote unquote, and value is often like, how much cheaper is it than the last a couple of years ago, whatever. Retail is like, hey, this thing's going up, like, it's my chance to hit my 100x and I'll chase. And I think that psychological behavior is what creates these boom and busts in crypto markets. And the bust often happens when you oversupply the market, right? So like, if you look at, the NFT market, for example, it was great when it was just like the Bored Apes and CryptoPunks and some of these high quality like NFT launches. And then we just, every week you had this new 10,000 PFP project that launched. And at some point you just saturated the market. Like the supply of stuff far exceeded the demand and the market collapsed. And then the demand even went further away because people were like, well, these things aren't going up anymore. I don't need this. Same thing happened in the ICO mania, right? So I think the cycle ends when like the market gets oversupplied with stuff. Where are we in the cycle? I personally think we're still relatively in the early innings. Again, retail hasn't come back to the same extent it has come back in the previous cycle, right? So the retail trading volumes at last cycle highs were multiples of the prior cycle highs. And we haven't hit last cycle highs. Just as a proxy, you can look at Coinbase consumer trading volumes and compare those two and see where we are. And you would think that, you would expect this cycle to be far greater than last cycle. Now, I do think you need use cases and something new and exciting for people. And we haven't seen that yet. Like there hasn't been anything new and exciting. Like last cycle, we had DeFi and NFTs and this prospect for gaming and play to earn. This time around, it's sort of been meme coins and SocialFi stuff, which is interesting, but not as like big and exciting. I do think stablecoin market cap going from, let's say, 160 billion to a few trillion will then get more people to come in and want to build things for that stablecoin market cap. And there'll be, again, all these beneficiaries around it. And I think that's what's going to drive this new cycle.
Got it. Yeah. Where can we send people to find you on the internet or find out more about what you're doing at VanEck?
You can find me at VanEckPK. It's probably the easiest place to look me up.
On Twitter?
On Twitter, yeah.
All right. And then anywhere on the VanEck website?
Yeah,
just
I don't
go to
know
VanEck.com?
Yeah, VanEck.com. Yeah, I don't look at the website, really.
All right. We'll definitely do it again in the future.
Yeah, sounds good.